Well, the Reserve Bank of India has cut the reverse as well as the repo rate by 50 basis points. But the question we're asking is this too little too late? Industry has been crying for this for months now, and we've seen 3 different rate cuts, very, very small size, since the month of December. To discuss that, I have with me Adi Godrej of the Godrej Group, Sumant Sinha of Suzlon, and Latha, Venkatesh, our banking editor. Mr. Godrej, I'll start with you. Of course, some rate cut is better than no rate cut, but is this too little too late?
No, I wouldn't term it too little too late. I think there have been considerable rate cuts in the past. Perhaps what could have been avoided if the rate increases when commodity-led inflation was taking place, but that's a thing of the past now. And I think measured rate cuts are good. We must look to see if inflation falls further, we should have another similar rate cut in a month's time or so. But I welcome this rate cut, and I think it will help provide both liquidity as well as low-cost finance for industry, but most importantly, low-cost finance for consumer purchases such as autos and residential real estate.
Sumant, industry, like I said earlier, has been crying for sharper cuts for many, many months now. This move we had been expecting for almost 2.5, 3 weeks now. We've been talking about it every single day. Would you agree with Mr. Godrej that no, this is enough, or that do you think that this is too little too late?
No, well, as he said, and I agree with him, every little helps. But the fact is, it is a little, it's not a lot. And at this point in time, with inflation where it is and the trend being very clear and what's happening in the international environment, we really need, I think, a much stronger push. And for whatever reason, the RBI has chosen to follow a fairly conservative route in this, and I'm sure they have their own reasons for doing so. But having said that, I think from an industry standpoint, clearly interest rates are still fairly high. And, it's not just the RBI's fault, however. I think banks are also taking advantage of the scarcity value of their credit and are actually charging much higher spreads as well. So while the RBI is trying its best, the reality is that bank lending rates are not really going down at the rate at which they should.
Well, Latha, I'll come to you with exactly that point. Lending rates are not going down finally to the final consumer at the rate at which they should. And if you wanted to bring consumers back to things like automobiles and other finance products, then a sharper rate cut always is more confidence building as opposed to 50 basis points in 1 month, 50 basis points in January, then 50 basis points in March.
Well, Menika, one thing you should remember, the Reserve Bank is only a signaling rate. It's not actually lending out money.
So it would have signaled lots more confidence if it had done a sharper cut, let's say in December, January.
It did. The signaling rate was 9%. It used to be the repo rate, and now the signaling rate is the reverse repo rate, and that is now at 3.5%. What we are looking at is a 5.5% move, which is very, very big in terms of a signal. Signals always in the past came in 0.25% and 0.5%. This is a huge signal that the Reserve Bank has been giving and has been giving for quite some time.
So you don't
but the dynamics of the banking system is very different. Money had evaporated significantly after the Lehman bankruptcy, and already a goodish bit, like Mr. Godrej was saying, of tightening had already been done. So banks had gone into a kind of a scarcity psychosis. Money will run out. They were borrowing money all through November and December, 9-10% deposit rates. Now, their pricing will be viable only when the deposit rates come down.
Sure, which is only what most leading private sector banks have been at least complaining about. PSU banks have been arm-twisted in some fashion or the other to reduce some key rates on products. Do you think that this move will help reduce rates? Sumant was talking about the fact that it's still very difficult for corporate India to get viable rates when it comes to lending. Do you think this will help in any substantial fashion?
No, not substantial. It will help in some fashion at the margin. The big problem is that this huge borrower called Government of India is also helping itself, in sackfuls from the banking system. That pushes up the 10-year yield.
Sure.
And ultimately, corporate borrowers will get at a spread over what the government borrows. And if the government's yield itself moves because of its own borrowing pressure, then corporate India, gets cheaper rates much later.
So even this is not going to help in the current prevailing situation where yields have been pushed up because of government borrowing. Mr. Godrej, that's not very confidence building. What do you think the Reserve Bank needs to do? Do you expect even sharper cuts to actually bring down real rates to corporates, by a substantial fashion?
Well, one of the problems is I don't think there is a liquidity problem as much as the problem that banks find good returns in investing in government bonds.
Right.
So when they get good returns from government bonds, why should they lend to industry? So I think that's a bit of a problem. I'm not sure what the solution to that would be. But clearly liquidity is much better than it was. More importantly, I feel consumer finance should be liberalized. I hope mortgage rates come down, and not just for the first year of a mortgage, but for subsequent years too. And if we see that, then affordable housing can play a huge role in reviving the economy, because there's a huge latent demand. If mortgage rates are at 8-9% are available for 4 or 5 years, at least the first 4 or 5 years, I think it could make a huge difference.